Why Turkey can't solve its hyperinflation crisis. It's time to add another country to the list of places where I'm not allowed to travel. Turkey, or Turkey, as they decided to change their name just a few hours before I started recording this video. Anyway, Turkey is simply a breathtaking country, full of history, culture, and some of the most beautiful landscapes you've ever seen. It's no surprise that until recently, Turkey was one of the most popular tourist destinations in the world, which greatly contributed to the enormous economic growth the nation experienced between the year 2000 and the mid-2010s. If I had made this video just 5 years ago, I would have told the story of an emerging economic powerhouse that could geographically and culturally be the link between the riches of the Middle East and the advanced economic systems of Europe. If you appreciate the video you watch and want to help us continue creating interesting content, we kindly ask you to consider the idea of subscribing to our channel and leaving us a donation to support us. Thanks to your support, we will be able to continue improving and offering you new insights. You can do it here below, through the appropriate buttons, subscribe, and thanks. Turkey is the 21st largest economy in the world by GDP and the 11th if adjusted for purchasing power parity. This makes it even more concerning that serious economic and political mismanagement is threatening to undo all the progress the country has made in the last 2 decades. For those of you who haven't been following the news, the country is currently experiencing extremely high levels of inflation that are subjecting the nation's citizens to almost daily price increases for the goods they need to survive. The most unfortunate part of all this hardship is that it is almost entirely preventable, and some simple measures could put it back on the path to prosperity very quickly. Unfortunately, it seems that the nation's government is unwilling to take these measures for some important reasons. So why is the value of the Turkish lira falling so rapidly all of a sudden? What impacts will this inflation have on the country's economy? Why isn't the Turkish government taking the widely suggested measures to alleviate this problem? And finally, could this be a sign of things to come in our own economies? Once we have answered all these questions, we can place Turkey in the national economy ranking. This episode of Economy Explained is brought to you by Skillshare. Another year is about to end, and if you're like me, you're probably in the process of setting a resolution for the new year that you'll abandon the moment it becomes slightly uncomfortable. The reason I find this happens is because learning new things and then applying that knowledge in a useful way is hard. That's where Skillshare comes in. For those who still don't know, Skillshare is an online library where you can learn practically anything, and you can learn it from people who are true masters of their craft. If your goal for 2022 is to never see the inside of an office again and continue working from home, then Skillshare has an endless library of highly marketable skills that you can acquire from anywhere in the world with a laptop and an internet connection. Even if you like your daily job, learning new skills is a great way to keep your mind active and sharp. The best part is that if you use the link in the video description, you can access Skillshare Premium for free for the first month. So if your New Year's resolution involves learning a new skill of any kind, you'd be foolish not to give it a try. Before we dive into the inflation crisis in Turkey, I need to make a big disclaimer. This is an ongoing problem that changes rapidly every day. For example, the country literally decided to change its name while I was writing this script. Although I will continue to call it Turkey because I'm not entirely convinced that this isn't some kind of elaborate joke, this is also a crisis with huge political stakes, which means that some announcements and even some economic figures might be more motivated by political power than by the pursuit of accuracy. But with that out of the way, Turkey is no stranger to inflation. In the 80s and 90s, the country experienced inflation rate peaks of up to 140%. The first peak was caused by the country loading up on foreign debt to fuel rapid growth during the 70s. This led to the economy overheating while the government racked up enormous fiscal deficits. The idea was that the country could simply grow its way out of this debt by becoming an export powerhouse, which on the surface wasn't the worst idea. The problem was that the government was borrowing money in foreign currencies, which meant that these loans had to be repaid in the same foreign currencies. This dangerous balancing act between borrowing and borrowing collapsed when oil prices skyrocketed in the mid-70s. At that point, Turkey heavily relied on imported oil to keep its economy alive and was barely surviving before this price hike. The government did its best to counter these problems with stimulus measures, but all it really did was devalue the currency. And since the nation's debts were primarily denominated in foreign currencies, it became increasingly difficult to repay these loans with domestic currency that was worth significantly less each passing day. The country continued to struggle with inflation hovering around 60% for the next 2 decades before establishing new mandates from the central bank in the early 2000s. Before this period, the Turkish central bank essentially did what the government told it to do. If the government needed more money to finance infrastructure spending, the treasury would call the central bank, and it would be more or less simple. The 2001 reforms changed this status quo significantly. The main issue was that the central bank's primary mandate would be on price stability. It could also help the government with growth and employment, but only if this did not come at the expense of price stability. There were also other significant changes made, such as the ban on the central bank purchasing bonds issued by the government on the primary markets. For reference, this is the way the Treasury normally raises money in the United States. So banning this exchange was a big deal. It meant that if the government wanted to borrow money, it would have to borrow it from investors who would likely be much more cautious about how much they lent, as they did not have the advantage of being able to print more money if it never came back to them. These reforms sent the message that Turkey would behave at its best. No more double-digit inflation, no more defaults. After gaining this autonomy, the central bank got to work raising interest rates to as high as 100% for a brief period in an attempt to stabilize inflation. This also reduced the amount of new money being pumped into the economy and simultaneously brought Turkey to a place where people wouldn't worry about putting their money. Unfortunately, there isn't much a central bank can do to put the genie of inflation back in the bottle once it's out. Decades of double-digit inflation had made the nominal value of the lira extremely low. This in itself is not normally a big problem. The Japanese yen, for example, is still a perfectly acceptable currency even though 1 yen is worth less than 1% of a US dollar. It's just that in the case of Turkey, the difference was too severe. It made international transactions difficult and also gave the currency a certain negative stigma. If someone gives you a 10 million note, instinctively you won't take it very seriously. To solve this problem, Turkey released the new lira in 2005, which was convertible with the old lira at a rate of 1 to 1 million respectively. This new monetary stability, along with the relative political stability, is what allowed the nation to grow so rapidly in the last 2 decades. Turkey does not have huge reserves of oil or gas. It has some oil fields, but they are small and do not even meet the country's own demand. As such, Turkey is a net importer of fossil fuels. While this means the country misses out on the easy riches of oil, we've seen time and time again that this can actually be a blessing in disguise. It removes the temptation to simply become an oil state. It also means that Turkey's growth has been built on more sustainable industries that have added value beyond just pumping or digging stuff out of the ground. Turkey is part of a customs union with the EU, which has meant that it has been able to trade freely and receive investments from countries within Europe. For this reason, it has built a solid industrial base in a short amount of time. It has a surprisingly large automotive industry where it is able to combine its relatively cheap but highly skilled workforce with its geographical proximity to major markets in the Middle East and Europe. Until recently, it was also one of the major tourist destinations. In 2019, it hosted 51 million international tourists, placing it ahead of places like Mexico, Thailand, Germany, and even the United Kingdom. Tourism is a fantastic sector because it literally means people flying into a country, spending mountains of money, and then flying back out. It doesn't rely on exhaustible resources and doesn't even require trade agreements. It's easy to see why Turkey was such a popular destination. It has incredible historical sites, breathtaking natural beauty, good travel infrastructure, and is relatively affordable. It is also a popular way for Western tourists to experience Middle Eastern culture and customs without venturing too far out of their comfort zone or into areas considered dangerous, whether this perception is true or not. So Turkey had a lot to offer. A great geographical location, developing industrial and tourism sectors, all backed by an autonomous currency seemingly under careful control. The government had also overseen this growth, doing a great job of avoiding debt, both through fiscal discipline and self-imposed restrictions on borrowing. The Turkish national debt has remained well below 50% of GDP since the early 2000s. So where did all this go wrong? The current problems the nation is facing started about 5 years ago, in 2014. Recep Tayyip Erdogan was elected president on a platform of conservative populism. He has also proven to be a supporter of the ideals of Islamic finance. A brief summary of this system is that typical interest-bearing assets are prohibited because they are considered by the faith to be usury. To get around these rules, Islamic banks will set up savings accounts where depositors share in the bank's profits, and borrowers lease to own the goods they purchase. If you want a mortgage, for example, the bank would buy the house you're interested in and then lease it to you at an inflated rental price for 30 years until one day the bank would simply give you the house. Some say this is just interest by another name. Others say this is a very important way to ensure that the beneficiaries of interest have a shared interest in the underlying asset. I'll leave this to the comments section to figure out. For now, the details aren't important, and all you need to understand from this is that interest is negative in the eyes of the President of Turkey. This became important because starting in 2017, Turkey discovered that it might have a small problem on its hands. While government loans were very modest, the private sector had taken on more and more debt to capitalize on the nation's rapid growth. All the new industries we just looked at needed to be financed, but the newly highly regulated central bank was very stingy with its new currency. This led many large institutions to simply borrow money from countries like Germany and the United Kingdom, which had the added advantage of attracting much lower interest rates. Like all highly indebted positions, the good times in Turkey were fantastic. This private sector borrowing created enormous wealth very quickly, but like all highly indebted positions, the bad times are terrible. These problems came to a head in 2016 when Turkey attempted to elevate itself from a trading partner of the EU to a full member state of the EU. It was overwhelmingly rejected, primarily due to concerns about human rights centered on the new president of the country. This caused foreign financial institutions to think twice before lending money and tourists to think twice before planning a vacation. As these sources of income dried up, many private businesses began to shut down because they were unable to meet their debt obligations. The situation was exacerbated by the drastic fall in the price of the lira, which made foreign currency-denominated loans relatively more expensive. The government's solution to this was to raise interest rates and introduce austerity measures to get their currency back on track, and this worked but at a high cost. The unemployment rate in the nation skyrocketed to 14%, the highest since the new currency was introduced. These high interest rates helped large businesses that were trying to repay their foreign debts and did so by making the lira more valuable in the foreign exchange markets, which meant that foreign currency debts were relatively less expensive. But they also harmed the average Turk who now had to compete in the toughest job market of their professional career. Erdogan won the elections with a populist platform, and many saw this increase in interest rates in 2018 as a way to save large indebted businesses at the expense of the common man. This problem came back with a vengeance in 2020 when businesses that survived the first debt crisis were facing the economic implications of the coronavirus. Remember that Turkey relies heavily on heavy manufacturing and tourism, two industrial sectors that have been almost shut down in the last 2 years. Once again, businesses were trying to honor their foreign debts, which was driving down the value of the currency in the foreign exchange markets. The central bank initially raised interest rates in an attempt to keep this currency devaluation under control, but President Erdogan had other ideas. He told the central bank to lower interest rates and fired a series of central bank presidents for not doing so. He is convinced that a less valuable currency in the foreign exchange markets is actually a good thing because it will make Turkish exports artificially more competitive as they recover from the impacts of global lockdowns. This is not entirely illogical reasoning. Many countries, particularly China, have had an active role in devaluing their own currencies because they know it makes their goods cheaper in foreign markets. The problem is that Turkey also relies heavily on imports for things like fuel, food, and fertilizers. The devaluation of the currency has meant that many small businesses and farms simply cannot afford imported goods that they need to continue operating their businesses. The unfortunate irony is that rich institutions have access to financial instruments like futures to mitigate exposure to currency fluctuation risks. Even wealthy Turks with savings have transferred their cash into US dollars or euros, further accelerating the decline in the price of the lira. This means that once again, it is the working class and small businesses that are most affected by this latest crisis. So if this strategy clearly doesn't work, why not raise interest rates again? Well, there's probably a bit of political motivation for this. Remember that Turkey may have a secular constitution, but its leader is still a staunch supporter of Islam and Islamic finance, so interest is bad. Raising interest rates would also seem like admitting defeat at this point, as the government has pushed the idea that the country can grow its way out of this problem rather than resorting to austerity as it did in 2018. The real shame in all this is that it is totally unnecessary. Turkey has very solid foundations. It has a good workforce of young and highly skilled citizens. It is not above a line on a sector, and during periods of stability, it has demonstrated a clear ability to grow rapidly. But all the bad decisions that have led to where it is now will probably seem insignificant compared to a new plan just unveiled by the government. Turkish banks are well aware of their customers' hesitation to have savings in Turkish lira, even with incredibly high interest rates on offer. Most people simply do not trust the stability of the currency. It's important to remember that while inflation has improved in the last 2 decades, it still hovers around 8%. To put that into perspective, many economists are freaking out at the idea that the United States might experience a 6% inflation rate over the next 2 years. This is why most Turkish banks offer accounts in dollars for people to save their money. This is how most of the wealthy people we mentioned earlier change their money from the lira. Deposits in these accounts do not attract the very high interest rates of lira-based accounts, but for most wealthy Turks, it is a sacrifice they are willing to make for the relative stability of the dollar. The problem this causes is that over time, people will start using US dollars exclusively, which means Turkey will lose its monetary autonomy. For some small countries, this is fine. For example, Monaco is not part of the EU but still uses the euro. The autonomy that such a small country would gain by minting its own currency simply isn't worth the cost involved in doing so and getting it recognized. For a country like Turkey, however, this would be bad news. It would not be able to set its own interest rates and would therefore lose a significant amount of control over economic growth and employment. A country with ambitions to be among the top 10 in the world will need its own currency to combat this dollarization. The government has announced plans to introduce a new type of savings account that will protect borrowers from inflation. The account would work like this. Any money deposited in the account will attract the central bank's cash interest rate, which at this point is 14%. And then, at the end of a fixed period, the Turkish treasury will pay an additional amount equal to the value lost due to inflation. For example, if you deposit 1,000 lira for 12 months, you will receive 140 lira in interest over those 12 months, assuming this is compounded only annually for simplicity. If the value of the lira halves in that period, then the treasury will assign you another 1,000 lira so that the value of your assets relative to the US dollar remains the same. It's unusual, but desperate times call for desperate measures. On the surface, this seems like a rather inspired idea. The government's guarantee effectively equates to a higher interest rate without having to call this higher interest rate. In our earlier example, you would be able to achieve the same thing by offering a 114% APR on savings. But if you simply call it a government guarantee, then you don't need to look at big scary numbers. Beyond the marketing spin, this could also encourage many Turks to trade their US dollars, which generate little to no interest, for inflation-guaranteed Lira that offers a 14% interest rate. This trading should drive up the value of the Lira in the foreign exchange markets, making regular imports accessible once again. Initially, it seems to have worked. The value of the Turkish Lira jumped over 50% after the announcement of these new accounts, but the good news ends here. Some skeptical journalists have pointed out that this increase in the value of the Turkish lira coincided with a significant drop in Turkey's foreign currency reserves. This could suggest that the government bought its own currency in an attempt to make it seem like this policy decision had a greater impact on public perception than it actually did. Obviously, this development is still ongoing, so it's hard to say with certainty that this is what happened, but it's also very hard to see an alternative explanation. In any case, the world's most expensive publicity stunt is not really the big problem here. What is the problem? It's the debt burden. This could expose the country to suppose that Turkish citizens accept this offer en masse and then the lira continues to fall due to poor monetary management. The treasury could be on the hook for paying out hundreds of billions of dollars. This would force the government to do one of two things. The first option would be simply not to honor this promise to top up bank accounts in line with inflation. This would obviously be extremely unpopular politically, so the government would probably opt for the second option, which breaks the rule of not borrowing money directly from the Turkish central bank. There is no other way the government could access enough money to cover this promise in the event that people actually accept the offer and inflation continues at the current rate. The government has exposed itself to a potential significant liability here that could quickly transform the current situation, which is a serious but easily fixable problem, into something that could push Turkey towards a fate like Argentina or Venezuela. If I had made this video 5 years ago, I would have told a very different story about Turkey. If I had made videos 5 years ago, I would have told a very different story about Venezuela. Now it's time to place Turkey in the national economy ranking. Starting with size, Turkey is one of the largest economies in the world, which is why it's getting so much attention in the news. A GDP of $720 billion in 2020 means it gets a 7 out of 10. The GDP per capita is more or less what you would expect from a developing country facing the problems we've explored in this video. It has fallen from a peak of $12,600 in 2013 to $8,500 today. It gets a 5 out of 10. Stability and trust? Well, what can be said? Even in the last 2 decades of relatively controlled inflation and strong growth, the country is not what you would call a safe haven. Political tensions and a perceived inability to manage a crisis mean that most institutions want to have as little to do with Turkey as possible. It gets a 2 out of 10. Growth is also poor. I might sound like a broken record at this point, but if I had made this video 5 years ago, I would have given the country a 10 out of 10 because the economy had more than quadrupled in size since the year 2000. Unfortunately, it's 2021. And we measure growth over the last 10 years. Turkey is down compared to 2011, so it gets a 0 out of 10. Finally, industry is the real tragedy because Turkey is fundamentally a solid economy. There's no reason why Turkey can't be a highly successful trading power in the region. It has a healthy and diversified industrial sector, but unfortunately, these industries have been victims of poor macroeconomic management. So for now, it gets a 5 out of 10, which gives Turkey an average score of 3.8 out of 10. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have. We will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.